Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Friday, April 3rd, 2009. The U.S. non-farm payroll report showed the economy shedding 663,000 jobs in the month of March, with the unemployment rate rising to 8.5%, the highest in 25 years. Those figures came mainly in line with expectations and had a limited impact on the markets in the immediate aftermath of its release. Some economists thought the data would be worse, and one indication of that is a revision to January's data that showed a steeper loss of 741,000, which was the third biggest drop on record. In a second release, the ISM non-manufacturing index came in below expectations, showing a faster pace of contraction compared to February. The news, along with today's jobs data, can temper some of the optimism seen recently regarding the U.S. economy. New orders fell and employment both showed sharper contractions. Overnight, the euro-dollar pair slid from its high from yesterday near 1.35 in a slow retracement. There was a slight head fake upwards following the U.S. non-farm release, then a move down to 1.3367 to finish the correction from yesterday's move, and in afternoon trading, we moved back up near the 1.3450 level. The dollar-yen pair rose above the 100 level, marking the highest the pair has been since November 4th of last year. Despite the data from the U.S., risk appetite continues in the currency markets, as traders bet that the worst of the global financial crisis may soon be over, which reduced demand for the yen and the greenback as safe havens. Part of that has to do with some better fundamentals coming out of the UK and US, but also yesterday's commitment by the G20 to pledge $1 trillion in help to emerging economies played into those beliefs. Stocks in the U.S. fell in the morning but rose into positive territory in the early afternoon. The greenback also came under pressure versus the Loonie, which extended its gains from yesterday, falling to the 1.23 level in New York afternoon trading. After consolidating overnight, the U.S. dollar-Canadian dollar pair hit a high near 1.2455 in the aftermath of the non-farm payroll release. From there, though, the pair's bears took control, especially as stocks in the U.S. brushed off the jobs release. The move in the second half of the week, which amounts to about 400 pips, wiped away the rise in the pair we saw last week. In the UK, the services PMI rose to 45.5, beating forecasts and adding another piece of positive data to come out of the UK recently. Though the figure still shows contraction in the sector since it's below the 50 boom-bust level, the pace of the contraction is slowing, a positive sign. Earlier in the week, manufacturing data also came in above expectations, and with some housing data showing a slight recovery in that sector as well, the pound has been a strong performer this week. A second report from the UK, the Halifax Bank of Scotland House Price Index, showed home prices dipped another 1.9% in March. Prices were down 17.5% on the year. The data came mainly in line with expectations, but it does go against the nationwide survey that came out yesterday showing a rise in housing prices for the month of March. The UK services data was the main mover for the pound, pushing the pound-dollar pair up after its release. The pair had been retracing part of yesterday's rally prior to the services data release, but jumped back above the 1.47 level in its aftermath, creating new resistance at the 1.4840 level. That moves us above the highs from last week, and the next level of resistance will be the 150 level that was set in early February. The euro-pound pair, after testing support turn resistance at the 0.9150 level, overnight fell below yesterday's low to set a new 4-week low near 0.9040. Those gains for the pound came in the wake of the U.S. jobs release, which matched expectations. The trend here seems to be strong as the recent gains in the pound are backed by better fundamentals and a rally in equities. In one more fundamental release, consumer prices in Switzerland fell more than expected in March, sliding 0.3% on the month and falling into negative territory on an annual basis, raising the risk of deflation in the country. The annual decline of 0.4% is the biggest since December of 1959 and was primarily led by a decline in oil prices, which tumbled 32% from a year ago. Other factors were a 4.8% drop in transportation costs and a slide of 1.7% in durable goods prices. Next week has two interest rate decisions from Australia and the UK. Both are expected to keep rates steady at 3.25 and 0.50% respectively. Some other important releases will be employment data from Australia and Canada and trade data from the US. On Friday, many countries will be celebrating Good Friday, with banks closed, which will affect liquidity in the currency markets. And that wraps up our coverage of the Forex market for this week. Thank you for joining us here at cmsfx.com. And from all of us here, we wish you a great weekend.